Hi, everyone. Good evening. Welcome to this webinar on Market Outlook and Portfolio Update. My name is Sunil Singh, and I'm the founder at Abacus. Hope you and your family are doing well. Um, I know this has been a very challenging period. The first 2 months, particularly, were very challenging, and then March turned out to be pretty decent. April started with a lot of promise, but what we have been seeing over the last couple of days, particularly pertaining to the Trump tariff, has caused a lot of ripples. Um, Amidst all this, I think the idea of having this webinar is to give you a little bit of perspective from our side of how to look at market. I know we are all very positive on the medium to long term, but we are all worried also about the near term. We'll also touch upon, slightly on our portfolio construct and what we are trying to do there, and then we'll have some questions as we speak on queries which you might have. Uh, just from a perspective of the market, I think, as I said, last few months have been challenging. Actually, if you see the financial year which ended in March 25, can be divided into two parts. The first 6 months, which was April 24 to September 24, was a great period. In fact, we hit an all-time high of 26,000 as far as Nifty is concerned in September 2024. It followed the challenging COVID period, but whoever was positive post-COVID has seen and reaped the benefit of 4 great years till September 24. Obviously, the second half, October to March 25, has been full of challenges. And just to recap, I think there have been various reasons of why these challenges came about. So some of the global factors included the Russia-Ukraine conflict, which has been ongoing now for more than 2 years. I think time and again there were concerns pertaining to that. You also had the Israel and Hamas issue, which led to even Iran get involved. And when Iran got involved and when there was really escalation as far as hostilities were concerned, oil also shot up to $85 a barrel, and globally markets were a little bit nervous. We have also had wide swings in currency, particularly Japanese yen. We saw huge swings, and that also led to backseat as far as the equity markets are concerned. Amid all this, there was also global factors. We had an election which was held in June 24. And though, the ruling party came back to power, which was taken positively, I think the margin of victory was something which caused initial sharp correction as far as markets are concerned. We also had major and multiple state elections, starting with Haryana, Maharashtra, and then Delhi. I think in all the three states, luckily, the results were better than what the market were expected, and therefore the initial concerns and anxiety was converted into some stability. I think the bigger reason for what we have seen in the market has been a few things. One is because of elections and because of multiple state elections, government spending has got delayed, majorly. We had till July, August, nothing moved because there was code of conduct. And then, in a few states where there was election, the code of conduct continued, and there were major states like Haryana and Maharashtra. We also had the budget, which got approved in July, and therefore the allocation to ministries, which normally happen in April, got deferred to August, September, and October. I think all this led to GDP of India fall to 5.2% in the September quarter. And though there has been some improvement in December quarter, I think this fall in GDP and deferment of government expenditure plus code of conduct led to corporate profit growth for Indian corporates in the quarter of September fall to only 3%. We have seen some revival in December with 5-6% profit growth. But I think given the valuations at which companies were trading at, I think this was something which was taken quite disappointingly by the markets and the market participants. With all this, we also had major supply of paper. We had foreigners which were big sellers, and I think Particularly in the month of October, you had massive sell India and buy China. It was the first month where we saw 1 lakh crore of net selling by foreign investors. And it was accompanied by selling by promoters, selling by PE funds, a huge number of IPOs at crazy valuation, and also QIPs, which came in. So I think all this led to major supply, and despite the flows in mutual funds continue, I think accompanied by overvaluation as well as slowing down of Indian economy, as well as corporate profit, I think we saw a major correction as far as markets are concerned. Just to give you the severity of the correction, in January and February, almost 1 out of 2 companies fell by almost 40 to 50%. And I think that was the severity as far as the fall is concerned. We did not see as much fall in Nifty because there were a lot of stocks like Reliance, HDFC Bank, Kotak Bank, Hindustan Lever, Nestle, ITC, and a few others, which had not gone anywhere in the last 3, 4 years, and they did not fall. And therefore, it is very wrong to see the movement of Nifty in the first 2 months because it was held by stocks which had not gone up, and therefore they did not fall. As we speak, there have been some positives which have come up. We have divided into a few segments. So first is steps taken by the government. So I think if you see, obviously the government has ensured that the fiscal deficit trend has been managed pretty well. In the revised budget expectations, we are looking at 4.9% fiscal deficit, which is significantly lower than the COVID high of 9.2, but it is almost equal to just the pre-COVID level of 4.6. And the indication also is that next year itself, we will have the fiscal deficit fall to 4.5%. In the budget, we have had major tax savings breaks. So, income tax has been reduced for almost every assessee, and that itself is a 1 lakh crore of saving. We have had higher spending allocations for rural and agriculture. We have also had higher, spending budget for infra at almost 11.5 lakh crore, and various other initiatives have been unveiled by the government to stimulate the economy from the budget perspective. At the same time, we have also had a change in the banking regulator. We have had a new RBI governor. I think the old RBI governor, or the earlier RBI governor, Mr. Shaktikanta Das, was also a great governor. However, in the last 1 year of his term, his whole focus was on containing inflation, and therefore there was a huge tightening of liquidity. The new RBI governor seems to be more proactive in balancing liquidity as well as ensuring that growth is not compromised. We have had the first cut in interest rate after almost 3, 4 years in the month of February, and it is expected that in April we will have another rate cut. We have had risk weight cuts for bank loans to NBFCs and microfinance. I think this will lead to higher potential and higher capability of these NBFCs to lend, again stimulating growth. The new RBI governor has infused a whopping 5,25,000 crore liquidity over the last 3 months, in fact, 2.5 months. And if you just go back, I think the earlier governor had sucked almost 5.5 lakh crores of liquidity from the system. So almost entire liquidity which was sucked out in the previous 15 months has been, infused back into the economy by the new RBI governor. Normally, this infusion of liquidity takes a couple of months to flow down to the economy and have an impact positively. And we are already seeing some signs of it. But we expect that from April onward, which is also the start of a busy season, we will have growth helped by this huge, liquidity enhancing actions from the RBI. In terms of rupee, rupee hit a high of almost 88, we were at 87.58. And since then, like today, the rupee hit a low of 85. And if you compare to some of the other emerging countries, I think rupee has been very, very resilient. In fact, after the last 3, 4 days move, rupee is flat year to date. Our foreign exchange reserves have also been quite resilient. And I think that again, highlights the strength in the Indian economy vis-a-vis some of its global counterparts. On the FBI front, the foreign, front, we have had massive selling continuously. And I think March has turned out to be a revelation. After a long, long time, we have seen, foreign investors turn net buyers in the month of March to the extent of $1 billion. It is not a large amount, but at least from a selling perspective, now they have turned buyers. Domestic investors continue to remain buyers, and I think that has been a major reason why March was a pretty good sort of a month as far as Indian markets are concerned. Along with the change in RBI regulator, we have also seen a change in the market regulator, which is SEBI. And the new regulator again has shown a lot of signs of relaxation. The first thing he did was increase the investment cap in listed companies for foreign investors from 5 to 10%. There was this regulation that any FPI which manages 25,000 crores will have to give granular beneficial ownership, and therefore a lot of these FPIs had restricted their size to just below 25,000 crores. I think the SEBI has increased that limit to 50,000 crores, and that would eventually attract and encourage more participatory note and fresh flows into the Indian equities. There have been changes in the settlement cycles, flexibility in some margin requirement. I think all this will lead to market liquidity boost. And there has been framework of, for passive fund houses and new asset class introduction, which will encourage more funds to be set up. And eventually that will also need to lead to more funds flowing into the equity markets. Early positive signs of measures taken by government, RBI, and SEBI are already visible. The GDP, which had, the initial estimates of September 5.2 that were increased to 5.6. December GDP growth has inched up to 6.2. The government is trying to end the year at 6.5. I think for that, the March GDP number will have to be closer to 7%. Let's see, we'll have those numbers earlier, but I think the trend is clearly looking like improving. Manufacturing PMI has been constantly over 50, 55, and that again shows expansion. And IIP growth has also now started to inch up to 5% plus as far as January data is concerned. So the indications are already there that economy is starting to inch up a little bit. It's slow, frankly, but at least it started to inch up. And as I said, the major impact of all these measures would be visible from April onwards. So we might start to see some growth accelerate there. Some other economic indicators, I think we have seen e-way bill growth at 18.8%, highway collections coming in at 15 to 20% growth. That again shows uptake. Electricity consumption has risen by 2%, and GST growth, collection growth, has been on an average 9 to 10% continuously for the past 3-4 months. In fact, in March, it was the second highest GST collection of all time, which we saw. Inflation has been under control. We have seen inflation, CPI inflation well below 4%, WPI inflation well below 3%, and as a result of which, we have seen the yields, the 10-year GSEC yield fall below 6.5% yesterday for the first time in 3 years. So I think all in all, the macro could not have been better. In terms of profitability, as I said, profit growth has been very timid. September profit growth was only 3%. I think December profit growth inched up to 5 to 6%. We do expect that March profit growth should be double digits. And at least our indication when we meet companies is showing that growth for corporate profitability in March will be at least 10, 11%. However, I think all the optimism which was coming in the month of March, and as a result of which, markets went up by 7, 8% in the month of March, have all gone washed out by one factor, which is Trump, Trump, and Trump. I think there was this view that since he became the president, he has been talking about tariff, but it was an on-off thing. And jokingly, we say that Monday tariff, Tuesday no tariff, Wednesday tariff, Thursday no tariff, Friday tariff, Friday, Saturday golf. I think that was his pattern. But what he has done on the 2nd of April, which he calls the Liberation Day, has never happened in the history of any economy. So reciprocal tariffs have been levied on every country, minimum 10%, maximum going up to 50%. India has also been hit by a 26% reciprocal tariff. It is lower compared to some others like China, which is at 34, 35%, Vietnam, which is at 45, 46%, Indonesia, which is 32, 33%. But the fact of the matter is that we have also got hit by the tariff, though at a lower level. Our view on this tariff is, as follows. One is, Trump is very unpredictable, so we don't know how this will pan out. At the same time, the biggest impact of the tariffs is going to be the US on US itself. So if you see yesterday, Dow, S&P, and Nasdaq fell by 4, 5, and 6% respectively. There were so many stocks, including the likes of Apple and Nvidia and Amazon, which fell by 8 to 10%. We had manufacturing companies like Nike, which make shoes, fall by 13, 14%. And it is very clear that the impact of this is going to be on US itself, US consumers itself, and US companies also. So, almost $7 to $8 trillion of investor wealth has been wiped out over the last 2-3 months in the US. I think there's going to be a massive, de-wealth effect on the US consumers. You have also seen US dollar, which had strengthened 110, fall to almost 101. US yields have crashed. Obviously, that will help their economy, but they have crashed, and that is clearly again showing signs that a recession is possible in the US. Again, it's very difficult, but our view is that the world cannot survive like this, and US will be the biggest country which will get impacted. Just an hour back, China has imposed 34% duty on US imports into China, similar to what US has imposed on China. And I think that is now, it's going to be like, unless it is controlled, it's going to be like a free war using trade as a weapon. We hope that sanity prevails and there is some, sanity in terms of what can be achieved. But these kind of tariffs are not, are not possible and can just not survive because nothing can be imported in the US. I don't know, even if they want Nike to open a shoe factory in the US, they need 5 lakh people who will work and stitch shoes. And I don't think it is possible given their wage structure and given their demographics of having that. So I think a lot of this is just for negotiation, tactics. But I think at least for the near term, uncertainty pertaining to these tariffs are going to be there, and news flow are going to determine which way the markets move. So, the day the tariffs were announced on Thursday in India, pharma companies went up by 6, 7, 8% because pharma was supposed to be exempted. And on Friday, the news flow started to come in that even on pharma, there is going to be tariffs. And almost every pharma company fell and gave back what they had gained on Thursday. We have also had, as I said, dollar index fall 201. The positive has been that crude has fallen very sharply to 6.7% to 667 dollars. All the metal stocks have also fallen because metal generally have fallen. And I think that is, as I said, a complete chaos, harakari, and uncertainty pertaining to Trump tariffs. But I would reiterate that the worst is already discounted now, and from here on, I think it is in the interest of everyone, including Trump as well as US, that there is sanity in what they are trying to do. Because if you are importing $500 billion worth from China, suddenly you can't stop importing. And if you're importing your basic needs from all over the world, you suddenly can't say that we're going to be charging you on everything you import tariffs. And the formula by which the tariffs have been imposed on each country is also very, very strange. But I think the Trump tariff woes and worries will continue in the near term. And I think to that extent, the stability which we saw in March has given way to a little bit of more volatility as far as April and the months forward concerned. Our view has always been very clear. We have been reiterating that the markets are not going to have a V-shaped recovery. We'll have a W-shaped recovery where markets will keep on going up and down based on news flow. However, we do believe that the trend is still optimistic. From India's perspective, I think India has been more proactive. Immediately after Trump became the president, our Prime Minister Narendra Modi made a visit to the US, and it was a great meeting. And just to give you in perspective, Trump and Xi Jinping, the premier of China, have not even spoken on the phone after Trump became the president. So I think India has, to that extent, been a little bit more, tactical, trying to build bridges. Post that, our trade team, led by Commerce Minister Piyush Goyal, visited US. US team has been visiting India, and the statements clearly say that both the countries are trying to find out a solution where they can deal with the tariff issue. India's trade surplus with US is not super great. It's $35 billion. Major exports obviously are pharmaceutical and gems and jewelry. On the pharma side, we have to see, but just to give you a perspective, I think India supplies pharma products to US at a fraction of their cost. There is a drug called Revlimid, which went off patent last year. Before it went off patent, the sales were $16 billion a year. That means that was a cost with the US population as well as the insurance companies were bearing. And once Indian generic companies started to sell that in the US, the cost fell down to only $500 million. So that was a straight $15.5 billion saving for US residents and insurance companies. Now, even if there is a 20% surcharge or reciprocal tariff, instead of $500 million, their cost will go to $600 million. They will still end up saving $15.4 billion. So I think sometimes, the news flow make us behave very aggressively in one direction. However, our view is that over the next few days, a lot of clarity and stability will emerge as far as this tariff thing is concerned. Markets have corrected. I would not say that they have corrected significantly in terms of valuation, but they are back to now the 10-year average from significant overvaluation. So as we speak, I think almost all the charts are at 10-year average. So we are not very cheap, but at the same time, now we are not very expensive. And if profit growth picks up in March and the trend and the outlook for the next year continues, then, the markets are right to give us that mid-teen kind of returns, which we have seen over the last so many years. What can go wrong? Obviously, as I said, Trump has levied, reciprocal tariff on so many countries, and China has retaliated. Now, Trump is a very egoistic person. Let's see what he does. But I think this geopolitical tension, along with what is happening in Russia, Ukraine, what is happening in other parts of the world, Mr. Trump keeps on threatening every other country. So we have to see that tariff trade wars are going to haunt. No one is sure of what will be the impact. Countries are not sure. Companies are not sure. Uh, I think all this can lead possibly to a global slowdown, though at least my view is that on the tariff front, there will be solution sooner than later because no country can survive with this. In fact, even in the US, there will be massive revolt because the biggest impact will be to every citizen. There has been a big loss of capital to them because of asset price fall, including equities. Their inflation is going to shoot up because everything they consume will become very expensive. There will be massive job losses instead of job gains because so many companies in the US will find it very difficult to even continue operations. So if you put say tariffs on cars from outside will not come. But every car manufactured in the US also has 70-80% of the components which are coming from outside. So it's very, very tough. I think we hope that it will not lead to global slowdown, but that's a worst case possibility. And the other thing to track, obviously, is rupee movement, FI selling, and interest rate scenario. In the very near term, all investors are going to be a little bit anxious, and therefore you might see global level, funds move away from equity into safe haven, but they would come also pretty fast. I think from an India perspective, things are better. One is I mentioned to you about the macroeconomic indicators. Across macroeconomic indicators, things are phenomenally good. On the corporate front, balance sheets have never been so good. I think the average debt equity ratio for India is at a 10-year low of around 0.5 times. We have seen a slowdown in corporate profit, but from here on, I think gradually there can be an improvement in corporate profit. More importantly, India is a domestic economy. India's reliance on export is very small compared to some of the other countries in the region. And even within that, I think exports are pretty well diversified, with US accounting for less than 20% of our exports. So I think all in all, India is in a relatively better situation, and you can also see that from the rupee, which has from a low of 87.6, it has appreciated to almost 85. Interest rate, again, India continues to be in a situation where interest rates are looking like going down rather than going up. I mentioned to you there was one rate cut in April. There's another rate cut which is expected in June. And the 10-year G-Sec yields also have come down to 6.5% for the first time in 3-4 years. So I think all in all, our view on the market is right now, as I mentioned earlier, of a choppy market. We do believe that the lows which we saw in the month of early March of around 22,000, 22,200, that's a great support. We do believe that you will have a up and down market with slight upward trending. Stocks have started to become cheaper than earlier. I would not say very cheap, but cheaper than earlier. And now there are options opening up where stocks look attractive from a 3 years perspective. Barring the near-term noise, I think it is going to be a market which is going to be stressful but interesting. Our advice is those who are already invested, please don't be in a hurry and get scared and sell off. Those who are looking at putting in more money, You should look at it, but in parts, because news flow based market moving up and down is going to be the order of the day. So maybe over the next couple of months or 3 months, you can look at deploying fresh capital. From an Abacus perspective, I think we have always believed in investing only in profit-making companies, companies with decent return ratios, and companies where there is valuation comfort. And to that extent, in towards the second half of 24, we became very cautious. And I think that caution led us to missing quite a few stocks where there was momentum, but valuations and profits was not to our satisfaction. And to some extent, you might say that there was a slight underperformance. I think all that is now clearly paying off. We do believe that the portfolios are pretty, well set. Yes, there are some stocks where there will be some action, but by and large, I think our focus on fundamentals and valuations have sustained. What we have been trying to do over the last 2-3 months is divide the stocks which we track into three buckets. One where the near term is decent and the outlook is also good. There, maybe the stock prices have not fallen. So we'll wait for an opportunity there. If because of external reasons, if stock price falls, that would be a great basket to invest. The second basket is where there is a near-term concern, but the medium and long-term outlook remains quite good, and stocks have corrected quite decently. I think that is the most interesting basket, and that is where we have shortlisted quite a few stocks. We have not been aggressive in investing because of the external environment, when we do believe that in choppy days, we might be able to buy those stocks at a discount or at a lower price. The third basket is there are some stocks where the near term is challenging and the medium term is also challenging. I think any uptick or any pullback which we get, we will be selling that to move to others. Just to recap, we have three main strategies. I think the first strategy which we run is called the all cap strategy. It's a mix of large cap and larger mid cap. I think the fund did very well. Last 6-12 months, the fund is slightly underperforming. And the reason I already mentioned, but I would recap. One is we moved a little bit more towards large cap, which hurt us because last year the broader markets were just moving up. And this year we are sort of slowly recouping that. Second is we stayed away from momentum, and it was a momentum market. And I think, again, our view is that if the portfolio is right, when the markets, stabilize and move up, I think the good stocks will move up, and that is where we are focusing on. The second fund which we have is an out-and-out mid and small cap fund. It is called the Abacus Emerging Opportunities Fund. In fact, we have been telling investors to put more money in all cap than emerging, but emerging even now has turned out to be a better performing fund. For some reason, we do believe that stocks there also are pretty much to our liking. And if you see our top 5-7 holdings have all done very well, even in this challenging market. The valuation there are to our liking. But, that fund by its very nature being 100% in mid and small cap tends to be more choppy and more volatile. There also we have been doing partial, churn in the portfolio, not too much, but the portfolio is pretty stable from a fundamental perspective. The third strategy, which we have been pushing a lot, which is the Abacus Diversified Alpha Fund. Unfortunately, that has not, performed in line with the benchmark, slightly lower. But again, the strategy is very good. We invest 40% in large cap, 30% in mid cap, 20% in small cap, and 10% in micro cap. I think the last 5-6 months have been tricky, but I think that's a great strategy from a 2-3 years perspective. I think overall what we can basically say is that fundamentally we are very, very confident on all the three strategies, the underlying portfolios. We do believe, it's T20 season. We do believe that 2020, the year 2020 to 2024 was the power play. And, across funds, we were able to hit it out of the ground. I think this year and maybe the next 6 to 12 months are going to be the middle overs, where the focus from our side would be in trying to protect our wicket rather than go all out, because there are so many moving parts and so many external factors which keep on, just playing. Like as I said yesterday, pharma was looking so great, and today all pharma companies were down. First 2 months, metals were doing so well, and today in one day, large companies like Tata Steel and Hindalco were down 8-9%. 2024, the banking sector did not perform at all, and now it's that one sector which even today did not fall. So it's been very very choppy. Our view is that one thing stabilize, India will stand out. If you again see the global environment, I think now the US also is a very dangerous place or a difficult place to invest. So now there are not too many regions where large sums of money can go. And if we are able to see stability in the geopolitical as well as the tariff-led war in the world, our view is that large sums of money can again start to come back to India, because we are looking at a GDP when things stabilize of growing to 6.5, 7%. Even with this tariff war, the impact on our GDP is going to be like less than 1% at the worst, even if these tariffs continue. But these tariffs should not continue, because otherwise US will just go belly up. And corporate profitability will slowly start to inch up. As I mentioned to you, the outlay on government spending is pretty decent. We are seeing huge infusion of liquidity from the RBI, almost 5 lakh crores already infused. And, now we'll also have the low base of last year. So year on year, profit growth will look pretty good. So I think optimistic, but cautious. This Trump tariff thing has obviously led to a little bit of more cautionary, view from us over the last 2-3 days. And it is something which is very difficult to forecast of how it pans out. But as I said, logically, it should not continue, because internally in the US itself, people would have become very anxious. So this is a short synopsis. I will now open the floor for any questions which any of you might have. Thank you.
Sir, the first question which we have received is, does the government have any way to ensure that the tax benefit gets spent invested in driving India's economy and not in imports or travel abroad? Do you have any estimate of percentage consumption on India service goods versus imports from tax savings, Bonanza?
So I think India's economy has been benefiting a lot out of the services side. Even now, we have a huge deficit as far as trade is concerned, to the extent of almost, $200 billion a year. But service exports on a net basis are almost $150 billion. And that's why our current account deficit is only 1%. So I think India is a net exporter of services. I think this travel abroad and all, yes, it is significant in absolute terms, but it's not very significant given the size of our economy. I think the government has been very judicious. Fiscal deficit, I mentioned earlier, has been kept under control. And that is the reason why the macros overall are pretty decent. And now with oil falling to $67 all of a sudden, I think if it comes down to $60, I think that would be music to the country, because then suddenly, we will be looking at a scenario where there will be no current account deficit.
So next question is, what Trump is doing, will that bring down the debt problem of US? If say he is able to bring investment business to US soil, how will the cost of labor/production be handled?
See, it is very difficult. The whole purpose of tariff is to encourage production in the country. But every country does it selectively. So India also has tariffs. So if you want to encourage domestic production, we also give incentives like the PLI scheme which we have given, or we will impose some anti-dumping duty and so on and so forth. But it is done selectively. I'll give you again the example of Nike. Nike is the largest footwear manufacturer in the world. It's a great brand. We would have all used it at some point of time or even now. Now, Nike has 5 lakh people working for it across 130 factories in Vietnam. Now, it's a very noble thought that why should we import from Vietnam? We should manufacture in the US. But tell me, to get 5 lakh people to work in manufacturing shoes in the US, one is you'll not get that many people. Second is those people would not be willing to work manufacturing shoes. And third is the cost. In the US, the minimum labor cost is $25 an hour. So on an average, $300 a day. I think that is a salary level which would be a monthly salary in India or in Vietnam or some other thing. So I think even if it's a noble cause, it is not going to be possible. The other thing is, there is a tariff on, say, aluminium or copper. Now, who is going to put up an aluminium or a copper plant in the US? One is, it is like very high capex. Second is the gestation to set up a plant and get it operational is 4 or 5 years. And there is a risk because what happens after Trump is no more there after 3.5 years, or 4 years. In 3.5 years, you'll have election again in the US. It's a 4-year term for the president. And the other thing is, where is the raw material? They don't have ore, and power everywhere is in short supply, and it is such a high price. It will be almost practically unviable to manufacture, copper or aluminium in the US. So I think some of these things may be having noble intent, but are practically not possible.
So next question. Given the strict stance of the Trump government, how would the journey for the markets be not driven by the fundamentals but by continuous news flows? How, as an investor, one can deal with these volatile times?
So news flow is going to continue. However, at some point of time, the impact of news flow will start to reduce. Now, this is the worst Mr. Trump could have done, right? He can't increase the retaliatory tariff or reciprocal tariff on China from 34 to 40 or 50. What will he do? Or on India from 26% to what? Or on other countries from, I was just reading some one country, which is like a very, very small country. He has imposed some 50% tariff. And one small island where there are no human beings, he's imposed tariff even on that. So I think it's been a more like a formula-based approach rather than a practical-based approach. As far as what we should be doing, frankly, we should be doing nothing. Because right now, whatever we are doing is not going to hold true even for the next 1-2 days. So I think this is a time to focus on just evaluating companies, seeing if some companies, now there are some companies which have fallen 30-40% over a matter of 2 days, and there might be some opportunity there. So I think this is a time where, at least for people like us, what we are trying to do is, instead of getting swayed, obviously we also get anxious, and we also get stressed by the sharp movement, particularly on days like today, where the small cap index is down 4% and there are so many stocks which are down 10-15%. It is very stressful. But I think the best thing to do, as I said earlier, is don't sell in a panic and don't buy just because prices have fallen. I think this is a time to learn of not to do anything, at least till there is clarity on news flow. And I'm very sure that that would happen in the next 1 or 2 weeks, not even longer.
So next question is Abacus view on sectors which we are bullish on.
So it's a very logical question, but very difficult also, because sector view is not even holding for 2-3 days. So our view continues what was there at the start of the year. I think financials is one sector where we are positive. I mentioned liquidity has been infused a lot by the Reserve Bank of India. Interest rates are coming off. asset quality is good. And with this interest rates reducing, there is going to be credit uptick also. And it is a sector which is not impacted by tariff to the same extent, very, very little collateral impact. So I think that is one sector we are positive. We are positive on pharma, but today's move obviously has punctured it. But I do still believe that, Indian pharma has a lot of capability and a lot of advantage, and it is going to be practically impossible for US to replicate the production of medicines in the US. And particularly Indian medicines, because we are the cheapest manufacturer of drugs globally. And India has almost 40% of all FDA plants in the world are in India. So that is again a good sector. We were positive on metals, but now we have to see. We are still positive, but if this trade war continues, then there might be a global slowdown, and which might lead to some demand slowdown. But that is going to be true for all. But I think that is again one sector which we are positive. We were started to get positive selectively on chemicals, but again now we'll have to see of what is happening. But I would say that is still a sector where one has to be, overseeing it. It should be pretty good. I think some sectors where there is structurally now an issue, I think IT, because if US is going to slow down, and I would say the biggest country at risk of a slowdown is going to be the US, then Indian IT companies are going to see some slowdown, because almost 75% of the revenues of Indian IT services company comes from the US. That is one sector where we should be a little bit wary of. And I think some of the other, I would say, not sector, but stocks, is where valuation comfort is still not there. So in a situation of risk off, even if the earnings come and the P multiples contract, you will have a massive fall in prices. We have seen some of the new age companies, some of the IPOs which got listed at some fancy valuation are all down almost 40-50%. And so just don't buy because the prices are down, because a lot of them are still also, even now, very expensive.
So view on keeping defense sector in watch list. What is your view on next 2 to 3 years for this particular defense sector?
I think it's a good sector in terms of opportunity size, because the government has been rooting for Make in India as far as defense is concerned. I think the only problem is one, there is only one customer, Government of India. Second is it's a long gestation sector. So from getting the order to the actual delivery is normally a 4-5 year period. And third is stocks are still very expensive in that sector. So while the sector view is positive, maybe from an investment perspective, you should wait for corrections more in that sector.
Next question. Indian markets have delivered positive returns each year for the last 9 years. Do you think the 10th year median valuation metrics are relevant?
So we started with a great last 3-4 years. I think we are still hopeful that year on year they will still be positive. But obviously, September high was 26,000 odd. Our view is that if this Trump thing sort of stabilizes, which at least I personally am quite confident that it should over the next 2-3 weeks, we should end the year at around what we saw in September 24.
Sir, do you think SaaS companies can also be affected by the tariffs?
So direct impact will not be there, but indirect impact is going to be on everyone if these tariffs continue. But I again reiterate, I don't have a view that the tariffs are going to be implemented in the way it has been presented yesterday, because that means that every country in the world will just go into recession. The collateral impact on every company is going to be high, because if demand drops, then obviously the SaaS company also gets impacted, and even the services company gets impacted. But I think we should just wait for the next 1 2 weeks, because many more things are going to be out, and what we talk today might not even be relevant after a week or 2 weeks.
Sir, can you please elaborate how US came up with 52% tariffs charged by India?
No, it is very simple. What they have done is imports into US, they have divided by the trade deficit with India, and that's how it comes to 52%. So whatever US was importing, divide by the difference in exports and imports. So the maximum tariff they can levy, therefore, is 50%. For example, if US is importing from one country $10 billion, they have a deficit of X, and the deficit is, as far as imports, is 2X, then 50% is what they will charge. That's how they have basically come out with that. So if you are as far as India is concerned, I think India is exporting. There's a trade deficit of 30 billion, and they've divided it by 110 or 115 billion, which is a total import from India. That's how they have come to this number.
So view on large cap, mid cap, small cap on 1 year point of view.
So very near term, I think they're all moving actually in tandem. So last 2 3 days, large caps were falling more than mid cap and small cap. In fact, mid and small cap were doing better. Today, large caps have fallen less, mid and small caps have fallen more. But in an uncertain environment, I think the large caps tends to be a little bit more stable. The only thing is that a lot of froth which was there in mid and small cap has got corrected in January and February. Having said that, in an uncertain environment, it is always better to have a diversified portfolio. So our view would be, don't put everything in mid and small cap. I think have a portfolio which is balanced across market cap. And that is the reason we are advocating diversified alpha fund, which has a mix of large, mid, small, and small exposure to even micro cap. Because it's going to be an uncertain kind of a scenario. It's not a trending one-way market. In ups and downs, it's always better to have a diversified portfolio.
View on gold and silver.
I've always been wrong, but I think gold and silver have seen huge rally. I think gold is up 50% in the last 6 months. I think so is silver. Silver has started to correct because it is also an industrial metal. I think from these level, I would not be a big fan of either of the two.
The view on auto and auto ancillaries space.
See, I think we can discuss every sector, but auto and auto ancillary, directly or indirectly, are going to be impacted by tariff, at least in the near term. So a lot of these auto and auto ancillary companies export, some directly to US, some to Mexico and Canada, which again gets assembled and goes to the US, and some even to Europe, which again, a big portion of the European cars are also exported to the US. So I think in the absolute near term, particularly export-focused auto ancillary companies will see some stress. So I think at least for the near term, one should be a little bit, in that avoiding kind of a mode.
The view on portfolio, our Abacus All Cap, Abacus Emerging, and Abacus Diversified Alpha clients who have invested in last 6 to 3 months odd. So what is the portfolio construction? How we are planning going ahead for these portfolios?
No, as I said, I think the last 2, 3 months, I would say 6 months, 6 months have been, very different and difficult. So, as I said, in the first half of FY25, which was April to September, we saw huge momentum and we were not comfortable with the valuations. I think the last 6 months has been more news flow based. And there again, taking a fundamental call has been appropriate, but has not played out definitely the way we would have liked because of news flow based issues. So Trump tariff has been on our heads since January, and then we have had massive movement of other non-fundamental reasons pertaining to some of the other factors emerging. I think all our portfolios, I mentioned earlier, all cap is a mix of large and mid. Emerging opportunities, a mix of mid and small, and diversified is across market cap. I think the portfolio underlying stocks are to our liking. But having said that, I think it's a period where we don't want to do anything exotic. I mentioned that, the way in T20, the first overs are the super overs, which was a period from 20 to 24. I think we are now in the middle overs where our intention would be to consolidate, work harder on the portfolio quality and fundamentals. Don't try to, hit fours and sixes in that sense, and wait for the environment to stabilize, which it should over the next 6, 9 months, before we again go into a really, really aggressive mode. And we are very confident that, portfolios are there. Like it's not that, emerging opportunities, for example, is doing very well. All cap is there. Diversified alpha is slightly underperforming, but we have no, doubt and full confidence that once there is time to hit these fours and sixes, we are up there. So I think it's a time to be a little bit patient. I would again reiterate that if you're already an investor, don't be in a hurry to get out. If you want to put in more money, again, don't put everything together because the markets are going to be choppy. Maybe spread it over the next 2, 3 months and try and build a decent portfolio. The last thing is don't have expectations of making 20, 30, 40% return. I think we are not very cheap. And, unless you are happy with a 14, 15% kind of a return, I think you would be disappointed. So have modest or reasonable return expectations, have patience, and invest in parts.
Next question. Which strategy of all the three strategies would you suggest have higher probability of consistent performance on a 5 to 7 year horizon? And won't mid and small cap portfolio be more apt for someone who wants to take more risk and generate better risk reward outcome on a 5, 7 year basis rather than 1 to 3 basis?
No, I agree completely. And in fact, I mentioned that we have been telling investors to diversify also out of emerging opportunities because it had done so well. But if your horizon is 5, 7 years, we have no doubt that India is a growing economy. If the economy grows from 4 trillion to 8 trillion over the next 6, 7 years, obviously these are the companies which are nimble, small, entrepreneur driven, which will grow faster. So definitely if you have a 5, 7 year view, you should look at a larger exposure there. But given the environment, from a 2, 3 years perspective, we will still recommend a diversified alpha kind of a portfolio where you will have a mix of all types of market cap companies. But yes, if you are willing to take that volatility, in your stride and have a 5, 7 year view, then a mid and small cap portfolio will give you higher returns.
So last question. View on global markets as compared to India in terms of valuation, and are there opportunities in China?
So, I think there is always opportunity somewhere or the other in the world. And China for 10 years did nothing. So from 2014 to 2024, total return made from China was zero. And those who had invested in India would have multiplied their money 4 or 5 times. That was the kind of difference. Obviously, Chinese stocks became cheap. But one thing we have to remember, in the last 4 or 5 months, Chinese stocks have moved up 20-25%, and the Indian stocks are down 15-20%. So almost 40%, there has been a differential return. The other thing is, in this whole trade war, I think China is going to be impacted much more than India because, one, it's an export-oriented economy. Second is US considers China as a bigger threat, and therefore the uncertainty in China is going to be higher. Third is, frankly, China is a very opaque economy. You can't make out what is exactly happening. So even if you invest in China, it would be a very small percentage of your net worth. And therefore, at least from my perspective, if 90-95% of your investments are going to be in India, for 2-5% of your investment, at least my view is that, we are not apt or we are not capable of tracking China. The other country which was doing well was US. But now with this whole Trump thing, I think US also is now sort of a big question mark. If you see stocks, the likes of Nvidia have fallen 35%, Tesla has fallen 50%, Amazon is down by 25%, Apple is down by 20%. There's been a massive fall in the blue chips of blue chips. So I think at this point of time, I would say that first let the world stabilize before taking a bet on investing overseas.
Thank you, sir. Due to time constraint, we may not be able to take more questions, but request you to drop us a mail at info@abacusinvest.com or service@abacusinvest.com. We'll try to revert as soon as possible. And sir, any last comments on markets and
I think
portfolio?
thanks everyone for joining. And I know it is a very uncertain and stressful period, but such periods have come every 2-3 years, in India and everywhere as far as investors are concerned. And I think those investors who have stuck to the core philosophy of having confidence in the country have ultimately ended up generating wealth. So stay confident, but at the same time, don't be greedy and don't be fearful also. I think these times would also stabilize. As I said, in the next 1 or 2 weeks, there will be much more clarity than what we have seen over the last couple of days. Thanks a lot for joining in. Thanks for all your trust and confidence in Abacus. We are very confident we will not disappoint you over a long term. Thank you.
All investments are subject to market risks. Please read all scheme-related documents carefully before investing. Performance and references to returns are indicative and does not guarantee any returns. Investor discretion is advised. This video is neither a general offer nor solicitation to avail the service of investment from the CB registered intermediary under the services offered by Abacus, nor is it an offer to sell or a generally solicit an offer to become an investor in the services offered by the Abacus. The delivery of this video at any time does not imply that information herein is correct as of any time subsequent to its date. The contents of this video are provisional and may be subject to change.